What's up, people? Welcome to the Stallion Financial Zone, and today we're going to talk about life insurance. Very important topic. Like I said, a topic that's not discussed, not a lot of people are talking about, and I want to definitely talk about that, more, especially since I am a life insurance producer in the state of New Jersey, and so I wanted to make that clear that, the information I'm covering, I'm able to tell it to you because I'm licensed to talk about it, right? So let's dive into it. We're not going to cover everything about life insurance, but I do think it's very important that you know some basic things about it. That everybody that should have some basic education when they're purchasing it, that they know what they're talking about and know what the agent or producer is saying when they talk about it. So let's dive in. Let's start. And I have my notes here as well because I don't want to forget some important things that I want to talk to you guys about. So let's dive in, right? Different types of life insurance. We have whole life insurance, we have term insurance, and then we have accidental insurance, right? Whole life insurance, I call it the when I die insurance or when you die insurance. So when you die, you want to make sure there's money to take care of your funeral, right? Because we know that's inevitable. We're all going to die at some point. We just don't know when we're going to die. So we have whole life insurance to take care of those permanent needs. It's a permanent insurance. It's there for the rest of your life. That's why it's called whole life. So it's going to take care of things when you die. So when you die, your funeral expenses need to be taken care of. When you die, you want to make sure that any debts that you have is taken care of. When you die, you want to make sure that your grandchildren have some money or you leave some money for your kids, whatever. But when you die insurance. Now, term insurance, I like to call that what if I die type of insurance, right? So it's a more temporary need. So you would get term insurance for needs like, what if I die before my mortgage is paid off? I want to have some money to take care of it so my family don't have to move out of the house, right? What if I die before my children grow up? I want to have money to take care of them until they're old enough to take care of themselves, right? What if I die before my children go to college? I want to have money to take care of their college education so that, I can help them, right? As most parents want to help their children in college, right? So those are the reasons for that temporary need. And when that temporary needs goes away, when your kids are all grown up or a mortgage paid off, then there's no need for that anymore, right? Then you have accidental insurance, which is the most amount of insurance you can get, most amount of coverage you can get for the least amount of money. So that only covers if the person dies in an accident. And that would make sense for a lot of young people because most likely anyone that's young, anyone that dies in an accident before age 65, dies before age 65, typically the reason is because of an accidental death, right? So those are the main three types. Now, whole life, a couple things with that. It like I said, it's permanent. It covers permanent needs. It builds what's called a cash value. So cash value is basically a value given to the policy based on how much money's put into it and how long it's been put into it. So there's a value given to it. You can borrow from your cash value. You have different options you can use your cash value for. Like if you wanted to surrender the policy and get the cash value from it, you can do that, which is what's called a non-forfeiture option, meaning they can't take that option away from you. You have it regardless. There's also what's called reduced paid up insurance, where if you wanted to stop paying at a certain point, you can use the cash value there to buy whatever insurance that will pay for, right? There's also extended term insurance, which you can use the cash value to buy. So, various things you can use cash value. Term insurance does not have cash value, so typically it's going to be a lot less expensive than whole life insurance. Term insurance doesn't give any cash value. It's just there for cover a temporary need. Typical term period could be 10-year term, 20-year term, or in some cases 30-year term, mainly used for mortgages, right? So that's term. Accidental, again, it's cheaper. You can get less, get a lot more coverage for less money. So that only covers for if the person dies in an accident. If they didn't die in an accident, then it's not covered, right? So not too much to say about accidental insurance. A couple other things I want to cover. For example, face amount. Face amount, that term means the coverage amount or the death benefit. So let's say it's $500,000. If you die, if your person dies, their beneficiary will get $500,000. That amount, that's the 500,000, $500,000, is what's called the face amount or death benefit. There's also premium. Premium is the money you're paying for the policy. So premiums could be paid either in monthly payments, it could be paid in quarterly payments, semi-annual premium, or annual premium. Some other rare insurance also have what's called single premium. That's not typical, so we won't really discuss that much. But some people might buy for estate planning or something like that. But the most common is monthly, quarterly, semi-annually, and annual premium. So that's what you would pay to keep your life insurance intact. Now, life insurance contracts are unilateral. Now, what that means is that only one party has to follow the contract, right? Which is the life insurance company. So they have to follow the contract 100%. So once they decided that they're going to do this contract with you after they do their underwriting, and I'll explain in a second what underwriting is, they have to follow it. So the person dies, they have to pay out that money, right? The only way they don't have to pay is if they could prove when they do their investigation that you did a misrepresentation on the application. The misrepresentation is purposely lying, saying something is what it's not. And even if you did do that, in some cases, they still have to pay. So for example, if the way they wouldn't have to pay is if you misrepresentation in terms of the insurable interest, having insurable interest or showing that someone is insurable, right? So for example, if you're saying this person is your wife when that person wasn't your wife, that person is just someone you know, then that's a total misrepresentation and they don't have to pay. But if you lied about your age to get a cheaper premium, they still would have to pay. They would have to just make the adjustment to what the premium would have been for that age and make the deduction and still pay the death benefit. So the insurance company have to follow the contract. Only thing you have to do is pay a premium. Once there's a contract, you pay your premium, you're covered, right? What else? We have the underwriting. I said I was going to talk about underwriting. Underwriting is the process before the contract is set in stone and signed and sealed. So when an agent comes to you to write up a policy for you, usually 6 to 8 weeks is the underwriting period. And that's for the insurance company to do their due diligence as they are taking on a large risk. To make sure that, they want to take that policy. Because again, once they decide that it's the policy's in place, they have to follow it. So they want to do their due diligence to make sure that they are going to be able to take on this risk of insuring you for that large amount of money, right? So they're going to do medical records, check your health history, all that. Do their due diligence. Once underwriting is complete and they set up the policy for you, the policy could either come back from underwriting as normal, However you write it out, it comes back that way, and the agreed upon premium is the same. Or it comes back as rated, meaning it's a higher risk. And therefore, when it's rated, you can either accept less coverage for the agreed upon premium, or you can agree upon paying more premium for the same coverage you applied for. Or it can come back denied, which means they just think this is too much of a high risk and they don't want to take you as a policy owner. So that's how it can come back from underwriting. So once it's back from underwriting and they do give you the policy, then they have to follow it 100%. Now, a couple other things that I want you guys to really understand is the different parties in a life insurance policy. For example, there's the insured, and that's the person that's being insured. There's the policy owner. That means the person that owns the policy. That doesn't have to be the same person all the time, but in most cases, it's the same person. So for example, I can be the policy owner for policy, but my wife is the insured, right? She's the one that I'm insuring on, and but I'm the policy owner. So they don't always have to be the same. So the policy owner is the one that owns the policy, that can make changes to the policy, that could cancel the policy. Whatever policy decisions, the owner is the one that could do it. The insured is the one that's insured. The payer is the payer of the policy. So again, payer don't have to be the same person as the insured or the policy owner, but that's the one that's actually paying the premium. And then you have the beneficiary, which is the one that's receiving the death benefit after the person died. So those are the four main roles that's played in a policy. You have the insured, the policy owner, the payer, and the beneficiary. All right. Why do people need life insurance? All right. They need life insurance for a few reasons. Final expenses, to take care of final expenses, right? Which is funeral expense. Everybody should have that. I think it's everybody's responsibility to make sure that that's taken care of. The least a person could do is make sure that when they die, their family don't have to stress or do GoFundMe or anything like that to bury them. They should have money in place to take care of that, right? So final expenses, income protection, especially if a person is the main breadwinner or if there's just one of the breadwinners. That person dying takes away the income. However, the bills don't stop coming because that person died. So you have income protection to put in place to cover for a number of years or however long so that other person could get adjusted to being without that income, right? Then you have mortgage protection or loans. Anything that any debt that you owe. You want to have insurance in place to take care of that, because unfortunately when you die, your debt don't go away, right? And the reason why they do that is because if that was the case, people who know they're going to die, there's nothing that's going to stop them from going to banks and running up credit and getting money, and then they're going to die and they're not responsible for it. So your family is actually responsible for your debt when you die. So I think it's very selfish for people who know that they have debt to not make sure that that's in place to take care of their family. All right, so their family's not responsible for that. And then children's education. Most parents want to make sure that they support their kids in their college education or trade school or whatever education that they pursue. They have money in place just in case they're dying, they're not able to be there for them to help them. And then there's estate planning. A lot of especially wealthy people use life insurance as a means of estate planning, so that when they die, the beneficiary, their family members don't have to worry about any assets that they leave for them through a will or a trust having to be taken out to pay. So they have a life insurance in place to take care of any debts that they have or any outstanding or estate tax or anything like that could take care of that, so they're not taking away from their assets, if you know what I'm saying. Those are some of the basic things. If you guys have any questions, please feel free to comment below. Let me know any questions you have. I can answer for you, or I can find the resources to get the answer for you. So again, this was just a basic video to go over some information that I think is really necessary or people should know about. So again, let me know if you have questions. I'll be more than happy to answer it for you. And don't forget to like and subscribe to the channel if you haven't done so already. Hit the notification bell so you're actually updated on any time I release a video. Until next time, see you then.